Okay, day 15, section 3. So we've talked about some of the determinants of exchange rates in the long run, like productivity and inflation. Now we need to talk about determinants of exchange rates in the short run. Now here's why the short run is different than the long run when we're talking about exchange rates. Because in the short run, trade in assets and financial transactions is a much bigger, important uh, component of exchange rate trades than trades in goods, right? So foreign exchange trades are about 25 times the amount of trade in goods and services across countries. What does this tell us? It tells us that really money is being traded largely not for trade in goods and services, but for financial transactions. And so we have to understand kind of how financial transactions impact the exchange rate movements in the short run. And so let's think about how this works, right? How do trades in financial assets impact exchange rates? Okay. Well, to purchase American assets, foreigners first have to buy dollars, right? So to bring it home, right? So once you put your money in the US, if you want to bring it home, you have to sell dollars. So we have to keep this in mind, right? That every international financial transaction is going to involve the trade in a currency, right? Both a domestic currency and a foreign currency. So the best way to kind of think about how this works is through a theory called uncovered interest rate parity, right? Uncovered interest rate parity. This is based on the assumption that we have capital mobility, that capital is pretty easy to move between countries. So what does uncovered interest rate parity say? Well, a couple of minutes ago, we just talked about purchasing power parity, which said that the price of similar goods should be the same across countries. Here, the idea is exactly the same, except we're not talking about goods, we're talking about financial assets. Uncovered interest rate parity says that the return on similar financial assets should be the same across countries, right? The return on similar financial assets should be the same across countries. Why? Because if that's not true, people will arbitrage, right? In other words, they'll try to take advantage of those price differences. So let's think about two countries. Let's call it the US and Europe. Let's say that you can buy a US asset, maybe this is a US Treasury bill, that gives you this return. So ID is the interest rate in dollars that you can earn by putting that in a US Treasury bill. Or you could go and you buy a short-term government bond in Europe, right? What's the return you're going to get from holding that European bond? Well, first you're going to get IF, right? The interest rate on holding that foreign asset. But you also have to account for the fact that the exchange rate could change over time, right? And so what is this? This is the exchange rate at the end of the period minus the exchange rate right now, divided by the exchange rate right now. This is just the percent change in the exchange rate. And that impacts your return, because what happens if I buy that European asset? I have to put my money in euros. And so I'm also vulnerable to any exchange rate risk in the euro, from the euro going up or going down. Notice here that I have to subtract the percent change in the exchange rate, right? I have to subtract that. Why? If the dollar appreciates while I have my money in euros, that's going to cost me return, right? So an appreciation of the dollar needs to be subtracted from my return in holding euros. Likewise, if the dollar depreciates, and this is a negative percent change, then a negative becomes a positive. That will increase my return from holding euros. So this is what interest rate parity says, is that the total return from holding your capital in a US asset should be the total return from holding your capital in a foreign asset. This should be true as long as there's a lot of capital mobility. In other words, as long as it's easy to move capital between countries. In general, capital mobility is extremely high between rich and developed countries, right? So this actually turns out to be a very, very good description of the world, quite honestly. Now, it's not a great description of the world everywhere, right? It's not a good description of the world if you're talking about Iran and the US, right? Because between Iran and the US, there's not a lot of capital mobility because there's sanctions and other barriers to trading, moving capital. The same actually between the US and China, right? There, as we're going to talk about, there's some pretty significant barriers in terms of moving capital between these two countries. So their interest rate parity is not going to hold particularly well. But between the US and Euro, between US and Japan, US and the UK, yeah, uncovered interest rate parity explains the world very well. And in fact, it explains the world extremely well because a lot of quants or kind of technical trading is basically going out there and checking, constantly looking at wide variety of interest rates across countries and trying to figure out where there might be some arbitrage opportunity to borrow in this country and lend in another country and make some money. So a lot of technical trading is actually based on uncovered interest rate parity, right? Trying to look for profit opportunities that they can exploit. So what does this say? What does uncovered interest rate parity say about what influences exchange rates? First, the return on foreign assets is going to impact the value of the dollar, right? For example, what happens if interest rates rise in Europe? Well, if interest rates rise in Europe, that's going to make the euro more attractive to investors, and it's going to make the dollar less attractive. So the demand for dollars should decrease, and the dollar should depreciate. Likewise, interest rates in the US impact what's happening to the dollar. For instance, what happens if interest rates in the US fall? Same thing. That would reduce the demand for dollars and reduce the dollar exchange rate. 1 and 2 are essentially the flip side of the same problem, right? If interest rates in the Europe rise relative to the US, that's the same as saying that interest rates in the US fall relative to Europe, right? So it's the relative interest rate here that matters. If both the foreign interest rate and the US interest rate go up by the same percent, it's not going to change anything. It's the relative change between the two that matters. Also, changes in risk impact your return, right? Oftentimes, the dollar appreciates during periods of volatility because the dollar is seen as a safe haven, that the dollar is seen as a relatively safe currency. In fact, we've seen that during the pandemic a little bit, is that a lot of money has, a lot of assets have flown into the U.S. or capital's flown into the U.S. as we've tried to protect against exchange rate risk, right? And then finally, future changes in exchange rates impact today's exchange rate, right? So let's think about this example. Suppose that in the future, the dollar's expected to appreciate. Well, if you think the dollar's going to appreciate in the future, what are investors going to want to do? They want to hold dollars today to take advantage of that. So if they want to hold dollars today, they will increase the demand for dollars, and what will happen to the dollar? It will appreciate today. So in other words, this is just how markets work. If the dollar is expected to appreciate tomorrow, it appreciates today, right? Because people are anticipating what's going to happen in the future, right? This goes back to what we talked about when we talked about stock markets, how under the efficient market hypothesis, prices reflect all available information. And that same holds for exchange rates too. Exchange rates reflect all available information on interest rates and inflation and productivity and growth and tariffs, right? All of this information, both today and into the future, that we have is reflected in today's exchange rate. Okay, so this is a really key point here on which to somewhat conclude our discussion of interest rate parity and exchange rates in the short run, is that the relationship between interest rates and exchange rates is a little complicated. When I've been saying interest rates here, what I'm really saying is that the real interest rate, right, the real interest rate impacts the value of a currency. So if real interest rates rise, then we would expect the dollar to appreciate, right? So just like in this example, if, well, I guess I worked through the exact opposite, but if the real interest rate in the US falls, the dollar should depreciate. So real interest rates, a rise in real interest rates causes the dollar to appreciate. A fall in the real interest rate causes the dollar to depreciate. But it is a little bit more complicated than that. What happens if interest rates rise because of higher expected inflation? So in other words, it's not the real interest rate that's pushing up the exchange rate, but it's inflation that's impacting the exchange rate. In that case, inflation causes the dollar to depreciate, right? So what I'm trying to say here, maybe not very well, is you just can't look at nominal interest rate and say the nominal interest rate went up, so the dollar's going to go down. We need to know what's driving that higher nominal interest rate. If the higher nominal interest rate is driven by a higher real interest rate, then the dollar could appreciate. But if the higher nominal interest rate in the US is driven by inflation, the dollar could depreciate, right? So once again, here's the main point, right, that needs to be clear to you. You just can't look at the nominal interest rate and know exactly what's going to happen to the exchange rate. You have to know whether that nominal interest rate is being driven by a change in the real interest rate or whether it's being driven by a change in inflation. So that is a lot, right? One of the reasons why exchange rates are so complicated is there's just simply so many things that can impact exchange rates, right? We've talked about multiple things, right? 8 or 10 things that impact exchange rates. And it's not just those values in the US, it's those values in every other country, right? So a lot goes into trying to understand exchange rate movements. Just to kind of think about a couple of case studies that illustrate some of these phenomena. There's the case study of what happened to the dollar during the 2008 financial crisis. Initially, what happened was that when the Fed lowered interest rates, the dollar fell and the dollar depreciated. Right at the beginning of the financial crisis, the dollar went down. But then as the crisis in the US lingered, and also as the Euro crisis began to hit, a lot of people began to see the dollar as a safe haven. And so the dollar went back up and the dollar began to appreciate. And as the crisis went on, the dollar increasingly started to appreciate, right? So as we went into 2008, 2009, the dollar appreciated. Even though there was a financial crisis in the US, strangely, people began to see the US as a relatively safe haven. What happened to the British pound after Brexit? The British pound fell quite significantly, and this continues today, right? The British pound is down, I think, relative almost 20% versus the dollar since Brexit. Why? Because British financial markets are seen as less attractive if Britain is really kind of pulling themselves out of the global community, right? What about the dollar today during the pandemic? Well, it's kind of interesting what's happened to the dollar during the pandemic. Sorry, you don't need to look at all my stuff on the NFL draft and what the Cleveland Browns are doing. You probably don't care. Here, this is what I want to show you. So this is actually the value of the euro versus the dollar, all right? So this is dollars per euro. So this is the value of the euro, not the value of the dollar. But look here, as the pandemic began to kick in Europe, and remember it kicked in Europe before it kicked into the US. The euro, right, began to fall pretty dramatically during the early part of March as Many people began to get it in Europe, and it still, hadn't really hit the US. And so the euro dropped quite precipitously. And then as the euro hit the US, the euro began to appreciate. In fact, the euro actually went up above where it started, right back here in February versus the dollar. So first the euro went down and the dollar went up, then the euro went up and the dollar went down. And then we had another little peak of the euro declining and the dollar going up. And I think this is kind of like safe haven stuff, but then a lot of that dissipated as the US economy really began to slow down significantly. And now what you kind of see here on a day-to-day basis is a lot of back and forth, but really notice it's not a lot different than where we started back in February. So, how I would interpret this is so much stuff has happened. And remember, it's only relative values that impact the exchange rate, right? So something has to happen different in Europe versus the US. So at first it looked like things are going to be worse in Europe. And then it looked like things are going to be yet better in Europe and worse in the US. And now it looks like markets are saying it's bad both places, right? And it's really hard to say that anything has fundamentally changed in the two countries on a relative basis. And so the exchange rate between the US and the euro really kind of ended up right back to where it was, right? Right back to where it was. So just to kind of summarize this, listen, exchange rates are very, very volatile, right? Having 20% movements in the exchange rate like we just have seen during this pandemic happens all the time. And they're volatile because there's so many things that impact exchange rates. Exchange rates are determined by the things that impact them in the long run, like productivity and tariffs and preferences and inflation. They're also impacted by short-run things like risk and interest rates. Monetary and fiscal policy impact these things, and for both countries. And so there's so much that goes into exchange rates that they can be very complicated and can have big, big swings on a day basis. So I have here, look at Keynes, right? John Maynard Keynes, the famous economist, was a self-made millionaire, and he made his money speculating on the foreign exchange market. He almost went bust 2 times, right? So if Keynes can go bust speculating in the foreign exchange market, I'll tell you, you can too. In general, these are very, very competitive, efficient markets with lots that's going on. And so, yeah, it's a war zone out there. I know this in kind of personally because my roommate for 3 years in college, for many years was a foreign exchange trader for Paribas Bank in Paris, which is the largest French bank. And so kind of keeping up with him, and actually visited him at his work a couple of times and watched him do some trades on the foreign exchange desk. It is not for the meek of heart, right? It is not for the meek. I mean, it is a dog-eat-dog, very, very competitive market with huge changes. Individual traders are really fighting against these high-tech traders, right? These electronic traders, which are really processing so much information so quickly. Yeah, right. It is a very, very tough and competitive business, and you have to be able to know a lot about a lot of things to kind of understand what's going on. So, all right, well, hopefully you understand a little bit more about foreign exchange markets. That really finishes our lectures here for day 15. We will be back for day 16 when we talk about the international financial system. All right, all the best.